Kevin, welcome. And where do you think people should be shopping right now?
Hi, Kelly, and hi, Dominic. Thanks for having me on today. Looking at the mortgage market as a whole and the companies that I do cover, looking at the largest two, both Rocket and in the wholesale channel, the UWMC, their stocks have gotten beat up pretty bad over the last year since they become public. Rocket's earnings are coming out on the February 24th. Definitely will be guidance on the origination pipeline for 2022. Expectations are for mortgage origination to be pretty much half of what it was during the record 2021.
Wow.
Rocket itself is, wanting to become more of a fintech company rather than just as a mortgage originator. The mortgage originator space right now is trading at around a 4 to 5 times multiple of earnings, and fintechs are able to earn a higher multiple, say 12 to 13%.
Right.
You saw that with expanding the platform into auto and other lenders and purchases such as Truebill.
And to be clear, just make sure everyone's caught it, you think Rocket could be an $18 company or around 12.5 right now. United Wholesale, that's another one that you like here. You actually say some of the regional banks could be beneficiaries as well. Maybe people feel a little more comfortable dipping their toes there.
Yeah, looking at UWMC, that stock could, along with Rocket, had gotten memed by the Wall Street Reddit traders. Also, the amount of float and shares that are available have shied away some institutions and the overall market cap of the companies. UWMC focuses primarily solely on the wholesale broker market, and it also right now currently pays a 9% dividend, which we believe is going to be safe for the foreseeable future. And a number of these mortgage companies and the regional banks such as Citizens Financial or Regions Financial have begun to increase their servicing book. So as rates rise, the value of that servicing becomes more and more valuable, and it acts as a buffer against raising rates and lower production.
So Kevin, it's Dominic here. One of the observations that a lot of lay people out there, like myself included, think about when we see higher rates is how much the refinance business can actually benefit if rates keep going higher. At what point does the refinance business start to become a headwind for some of these companies, and who's most at risk if refinancing volume starts to go away?
Yeah, I think definitely. I think amongst the smaller lenders, the technology advancements that have been made at the larger mortgage companies have made it easier and easier for them to process mortgages in a faster way. And I think going forward, kind of rates where they are, everyone can pretty much come up with the same kind of rate unless someone's running a special or wants to capture more market share. But I think it's more on the delivery side of the larger, more non-bank mortgage originators taking the average time to close from 40 to 60 days down to, right now below 20 days on average, where they can close those mortgages. On the refinance side, as mentioned earlier by Diana, you're going to see more cash out refis, but that business is expected to slow down. But as I mentioned earlier, the servicing platforms that these companies have will be a huge buffer going forward.